What's up, guys? Welcome back to another episode of Behind the Facade. I am your host, Gavin J. Gallagher, and on this podcast, I explore the mental and emotional game often playing out subconsciously, both in your mind and the mind of everyone else in the real estate or property investment market. The key to success in this game is to master your mindset and behavior, to take control of your thoughts, your emotions, and most importantly, your ego. Welcome to the show. Guys, real quick before we begin, just want to ask you a quick favor. If you can, please stop what you're doing and leave a review for the podcast. Whatever platform you're listening in on, if you can give us a 5-star or whatever the highest rating is, it would be fantastic. And even better, if you found it useful in any way, please write that down on a very brief review if that's possible. It makes such a difference to how the podcast is received out there and pushed out on various platforms. That's all, nothing else to ask. Now let's get on with the show. What's up, guys? Welcome back to another episode, and it is a brand new year. We're into 2026, and what I'm going to talk about this week is part of the stuff that I cover with my coaching clients, and I'm going to be going into the topic of risk. And this is actually all inspired by the shocking news that Donald Trump had sent the troops into Venezuela, and they managed to find the president Maduro and basically take him and his wife out of the country back to the US, where apparently he is going to stand trial in the US for all sorts of drug trafficking violations and things like that. Now, there's all sorts of political stuff that I could go into that I don't think I'm going to go into right now. But what I will say is this is one of the aspects of risk that I'm going to go into today. The area of unforeseen risk or political risk. There's different types of risks, and we're going to be covering them today. But when I'm looking at a deal, or if I'm looking at an opportunity, what I will often do is I'll break it down into 3 simple areas that I want to assess or consider. And I call it the O or C model. And it's a framework that I've come up with, and the O stands for the opportunity itself. So that is, the asset that you're looking at, the potential of it, what's the return, how are you going to go about getting it? That's the opportunity. And then the next one, the OR, is for risk. And what we're talking about here is what are the risks involved? And there are quite a number of risks. And then the C in the O or C model is capital. How much capital or money do you need to raise in order to carry out the opportunity? An opportunity is never just simply buy a property. Well, I suppose it depends really on your outlook. The way I look at property investment is I don't look at it as an entirely passive thing where you buy something and then you just let the market do all the work. I prefer to bring some of my own creativity and resourcefulness into the mix so that I can create value in the asset. And so when I'm looking at a deal, what I'll actually consider is the hypothesis. What that is basically what do you believe is possible and what's your plan to achieve that? So questions you might ask yourself, am I buying this on the cheap? Can I sell it for a profit? How much do I have to spend on this to add significant value? And how quickly can I go about doing that? That is the hypothesis that you might kind of look at. And then when you actually buy it, you've actually executed on the decision. You had your hypothesis, you thought it was willing to have a go, and then you've gone ahead and you've bought the thing. And now it's all down to your ability to execute your plan. You had a belief and you had a kind of a plan in theory. Now the execution is you carrying out that plan. And this is where you find out whether or not you have the knowledge and the skills and all that kind of stuff, or whether you find out that you've over estimated your skills, or you've overestimated what can be achieved for the money that you have, or whatever. So it's very important. The hypothesis is very important, but also the execution is super important. If you don't have the execution down, then you're not going to end up at the end result, which is the outcome. And so it's very important the two to combine. A hypothesis plus execution equals outcome, and the outcome is either better or worse than your original hypothesis. So anyway, we're going to get into the OR version, or the OR part of that framework, and we're going to look at risk. And I know when many of you hear the word risk, the automatic assumption is that must be a bad thing. If there's risk, then it's bad. And the reality is risk itself is not bad. It's more of just an assessment or a measure of the various outcomes that are possible. And so it's not really down to whether or not risk is good or bad. Risk is not ever eliminated by your knowledge. It is really managed by your judgment. And so we get into a lot of different frameworks inside of my program. But it really boils down to a simple sort of matrix that I've come up with. And it asks a couple of simple questions. And the first question is this risk inside my control or outside of my control? And that's a fairly fundamental question, but can you control whether or not this risk actually turns out to be a real problem for you? Or is this something that's very, very unlikely and something that you don't really need to be concerned about at all? But a lot of the time, people kind of jump into thinking about the deal and thinking about all this. And I think it's kind of important that what you should be doing at the very outset, before you go down that road, is you should be looking at your own sort of relationship with risk. And the reason I say that is I have seen people that do not tolerate risk well at all. They have a very, very poor sort of risk tolerance, we'll say. And they're people that will be up all night. They'll be worrying. They'll be losing sleep over some mistake that perhaps they made, and now all of a sudden it's starting to come home to roost, and they're finding it very difficult to sleep. That is an awful thing to have to go through. And so you have to run this assessment on your own mindset and ask yourself, are you a person who's comfortable with risk, or is this the kind of thing that's going to keep you up at night? And if it is something that is going to keep you up at night, then you really have to ask yourself, is it worth pursuing this as an endeavor? Because if you can't sleep at night, then really the rewards, you have to ask yourself, are the rewards worth that kind of sensation that you're going to feel? You can end up putting yourself in an early grave if you're not careful. Now, the other thing, there's an assessment. Now, I've mentioned it on this podcast many times before, but there's a thing called the analyst versus the gambler. And this is, I often draw a sketch, and the sketch is kind of like a seesaw. And on one side of the seesaw is the analyst, and on the other side of the seesaw is the gambler. And you have to ask yourself, where on that seesaw do you sit? Are you more on the gambler side, or are you more on the analyst side? And there is no right or wrong answer here. It is simply, do you know, have you got self-awareness of what your traits and personality is like? If you sit right smack in the middle, then you're what I would call agnostic. You really couldn't care whether it goes one way or another. But a lot of the time we sit on one or other of those extremes. And if you're a person who is a gambler, now I self-identify as a gambler, or certainly at the outset of my career, I saw myself very much as a gambler. And that was, a lot of the time, I was driven by gut instinct. I was driven by emotion. I would suffer from FOMO. If I saw friends or acquaintances doing well on something, I'd be thinking, whoa, I want to get in on that. And I'd be, jumping in without really knowing what I was doing, but just knowing that they're in it, and so I should be in it too. And when you're a gambler, you suffer from things like cognitive bias. Now, I've talked about that before in this podcast, but cognitive bias is where your mind makes these with shortcuts, and you assume something just because it seems like the most obvious answer. But if you were more of an analyst, you would see through that, and you would recognize that you're kind of being selective as a listener, and you're not, looking for all of the negative news. You're actually really just looking for the good news. And then on the opposite scale is the analyst. And the problem with being an analyst is that you fear that you're going to make a mistake all of the time. And because you have that fear, you often confuse uncertainty with danger. And if you're confusing uncertainty with danger, then you're going to find it very hard to act. You're going to require certainty in order to take action. And when you're into that kind of mindset, what happens is you end up analyzing a deal to death. You end up with what we call paralysis by analysis. And that's where you're thinking to make an offer on a property, but the numbers are not, absolute no-brainers. And so you're there sitting on the sidelines kind of wondering, oh, should I do it? Should I do it? And you keep on crunching more and more numbers. By this stage, the gambler already has that bagged. That deal is now his. And that's what happened with me. I would often secure property very quickly because I didn't spend so much time on the analysis. Now, it all came home to roost when eventually the market turns, and that's when the deals that you jumped into very quickly turn out to be problematic. And all of a sudden, the analyst would not have gotten themselves into that trouble. Had they sort of made an offer, they would have already known that this is actually not worth making the offer at that price. So these are just some of the things that you really need to run by when you're asking yourself this. You want to just make sure that you're understanding mindset-wise, are you a person that enjoys risk taking, or are you a person that's going to sort of be up at night? And it's only after you've done all of that can you really then start thinking about the deal in terms of the different types of risk that might exist. And first thing I would say is it's not obvious straight away. A lot of the time people will just be simply thinking the risk is that the tenant stops paying you rent, or the risk is that the property market falls and you bought something for 250 grand and it's now worth 150 grand or something like that. Like, those are two risks, but there's a lot more types of risks that are out there. And so we're going to go through some of these now. And when you're looking at risk, what you've got to think about is that something that I often use in my sort of, I suppose you would say this is your risk filter, is whenever you're thinking of buying something, ask yourself, am I buying this cheap, or am I paying, am I getting good value for this? The only way you're going to know that is if you're assessing values of other properties in that area. And it's only if you know that you're able to buy it cheap that you know that you can sell it for a profit. Or if you know that you can buy it at a certain price, and if you spend so much on it, you can add a specific amount of value. You have to know these things before you can actually really understand what the outcome is likely to be. Then the next question is, can I do it quickly? And the reason that is really important is because sometimes risks that are in your control at the outset can move into a situation where they're out of your control over time. So let's say you buy something and the mortgage interest rates are nice and low, and you're thinking, oh, this is great. There's a huge profit to be made every month with this because I bought it at this price. But if interest rates spike all of a sudden, then 2-3 years from now, you could be paying, $1,000 a month more in interest or something like that. And now all of a sudden you've moved from, because time has passed, you've moved from something not being a risk to being a risk. And so you have to look at this from a timing point of view. You have to have a look at it from a location point of view. When you're looking at locations, are you thinking about the area in terms of, if you were living there, like how far away is it from public transport? How far away are the local amenities that you need? If you're renting to families, they're going to need to know that there's a school in that area. If you're renting to professionals, then how close is the business district that they're likely to work in? If you're renting to, we say, students, how far is the college? If you're renting to nurses, how far away is the hospital? All of that comes into location risk. And the next thing is tenant risk. We'll look at, nowadays it's become very obvious that tenants are, because of the RTB rules and that we're dealing with here in Ireland, tenants are often a terrible source of problems, where you have a tenant moves in and then either not because they're problem people or anything like that, but let's say their employer lets them go. Now they have a problem. They don't have enough money coming in. They can't pay the rent. But they're kind of thinking, well, you can't make us homeless. Like, we can't be living on the street. We have kids here. And so now all of a sudden they're staying in your property, but they're not paying you the rent as they're out there looking for work in order to make ends meet. That is a tenant risk. And obviously, there are guys out there that actually play the system and they're looking to do this to an unsuspecting landlord. And then there are innocent people who just get caught in an unexpected firing or whatever it is. But one way or another, you as the landlord, you're caught by this situation. So you really do have to look at the financial strength of your tenant. Does the tenant have a secure job? Does the tenant have enough income coming in every month to comfortably cover the rent? And a lot of people are uncomfortable asking to see evidence of this, but this is your livelihood. If this is, your portfolio, and you've got a mortgage payment every month yourself, and then you're relying on the tenant paying their rent in order to meet that, this is an important thing to consider. Now, closely related to that, we have a thing called leasing risk. And leasing risk might sound like tenant risk, but it's not necessarily. It's more a situation. Now, here in the Irish market anyway, we would not have a problem with leasing risk in the residential sector because, there's such an acute demand for property that anything at all, if it was to come on the market, it's probably going to have dozens of people chasing after it. But that is not the case in, we'll say, the office sector, or it's not the case in certain villages and towns that have got retail units on the main street, and you can drive through these places and there's lots of boarded up shops and stuff. That is leasing risk. Very obvious. Some landlord bought that property, thought that he'd get a tenant into it, and 2 years later still trying to rent it out. I have been that landlord. I made those mistakes, and then I suddenly realized how difficult it can be to rent something to a tenant when it's in a certain location, or when, there's certain factors that can make it less likely for a tenant to want to rent that property. And so that is leasing risk. And when you get into that, you have to start offering them money and all sorts of stuff. All of this stuff, to a degree, is in your control, insofar as when you're looking at this deal at the very outset, you can decide whether or not location is in your control or out of your control. Like, you can decide not to buy the property. So it is in your control. But the question then is, can it be mitigated, or can that risk be managed? Now, in the case of a location, either the property has the stuff that it needs or it doesn't. There's not a lot you can do. Like, if there's not a bus stop in that area or a train station nearby, you're not going to be able to influence whether that does take place. So that is a risk that cannot be managed. And so at the outset, you can just decide, no, it's not worth the risk of buying that property. But there are certain risks where you actually do have control. And so in the case of the tenant risk, you would say, do you have control over whether or not the tenant loses their job or whatever? No, you don't have control over that. However, it can be managed and mitigated insofar as you can have a very rigorous policy of just checking the financial strength of your tenants, contacting their past landlords and looking for references from employers. All that kind of stuff just lowers the risk of you finding somebody that then suddenly loses their job very quickly after that. When it comes to leasing risk, can that be managed? It can and it cannot. Like you might say to yourself, if I buy an empty property, that is a substantial risk that I'm taking on. But if I get it for a good price, then perhaps it's worth my while to do that. And perhaps if I say to somebody, this unit is available for rent and I'm giving 6 months rent free, that might actually be the incentive that somebody needs to go and take that place. And suddenly it's no longer vacant. And so there's certain ways you can look at this. Is it within my control, yes or no? And then if it is not in your control, can it be managed or can it be mitigated? And those are the kind of the filters that I look at when I'm assessing my risk. Now, there's a lot more. I'll go quickly through some of these just to kind of give you an idea. We talk about the market risk, okay? At the moment, and I know a lot of you will be listening, and you're probably more interested in the residential market than you are in the commercial market. And if you're looking at property in the residential market, then the market is very, very hot at the moment. The economy, as far as residential investment property, it's pretty good. Like, it's growing every single year. Now, there are certain rules and regulations and price caps and things like that being brought in, but the market is hot, and so it's a pretty good market. However, over time, will that always be the case? You have to run that assessment. And if you're in another jurisdiction, if you're listening to this podcast and you're sitting in the UK or Sweden or somewhere like that, it could be very, very different. You could be sitting in certain markets in the US where it does not work the same way. You could be in Canada and you could be in Australia. Like, there's a lot of markets around the world that operate very, very differently to the way we do here at home. And so you have to understand that market, and you have to know. For example, we talk about Dubai. I'm actually heading to Dubai in a couple of weeks for a holiday. And I know that Dubai is, it's a phenomenal market, a huge amount of interest in the place, millions of people kind of pouring in every year as tourists, but also people moving there as residents. And so this is pushing up property prices. But a lot of the time, the market responds to that by bringing a huge amount of property to the market as new developments. And what often happens is this splurge of new properties all hits the market at once. And you end up with a greater amount of supply than there is demand. And so when that happens, there is a glut, and it will affect prices in the short term. And what happens is suddenly developers need to get properties off their books, and so they start discounting prices and things like that. Now, I've seen that happen in Dubai, and I know that Dubai is such a massive market and it's so active and dynamic that is actually a risk. And there are certain areas that are very fringe. There are new developments that are way outside of the prime areas. And if you're in those kind of external fringe areas, there's a very strong chance that you're going to get caught in the next downturn. So that would describe market risk. Can you control it? No, you cannot. Can you mitigate against it? Well, that is debatable. Like, if you get it for a good price, yes. If you go and lease it to somebody and you find somebody that wants to do some sort of a long-term, 5-10 year rent deal, then it's fine. If it's a very attractive property in a prime area, then you're probably fine. But if you're a new development, like, look at all of the properties that were developed in China. China ran amok with speculative development. And somebody said that there's something like 40 million apartments sitting empty in China at the moment that were built speculatively, and now there's no buyer for them. 40 million, that's like the population of France. So think about this. Market is not in your control, so you do have to be careful about it. Financial risk. This is when it comes to cash flow, and it's usually determined by interest rates. So what are the interest rates? If your interest rates are fixed with your bank, well, then you obviously have a little bit less risk than the person who has a floating rate. A floating rate means it can fluctuate up and down. Now, of course, there's a positive to that, because when rates are falling, your floating rate starts to fall as well. So all of this is something that you have to be watching, but you don't necessarily have control of it. It just means that when you think about what level of control do you have over the situation, if you don't have a lot of control, then you have to ask yourself, okay, what would the cost of failure in this particular area mean to me? And sometimes failure is, it's a minimal enough risk, and maybe it's just, it's going to hit you in the pocket a little bit. But in other times, as I found, failure, like for example, the leasing risk I talked about earlier, when that fails, your asset dramatically falls in value, to the point where I actually ended up selling the property at a massive loss. And that was very, very painful. Another one to consider, asset risk, and that is the condition of the asset itself that you're buying. So let's say you've just, you found a lovely property that was built in the 1950s, and you're saying, oh, it's a lovely location, nice big garden. That's great, but there is a few risks that you're running there, insofar as, your electrical system could be crapped out and you need to go and replace it. There could be various problems with the house in terms of rising damp and all that kind of stuff. So you do need to assess the condition of the property. And like a property of that age, you can obviously expect a certain amount of problems and issues that are going to have to be rectified, but it's best just to go in with your eyes open. So you bring a building surveyor along, you get them involved, they'll run an assessment of it, and they'll give you a report, and the report will tell you everything that you need to know. Something that is often not thought about at all is regulatory risk, but it is now starting to feature for everybody, because regulatory risk, very much here in Ireland, we all know that March 2026 is this deadline now where new leases after that date are going to have an automatic 6-year right to tenancy. And so that is a regulatory risk. But there's also other ones. If you think about it from the point of view, there's a lot of people who are listening that might have either heard of the HMO model, or they might be thinking about embarking on a HMO portfolio. And some of the guys in my group have done it, and they've done it very well, and it's very lucrative for them. However, there is regulatory risk running that portfolio, because certain countries around the world will have licenses and rules and regulations around using a property as a HMO. And a HMO meaning house of multiple occupants. This is where, rather than renting a house to a family, you split it up into rooms and you rent it on a room by room basis. Usually you can do a lot better doing that. But the risk is that in a year or two's time, maybe the local authority that governs the planning in that area says, this is no longer permitted as a use. You need to license the property. Or they come in and they do run an assessment and they say, this room that you're renting out is too small, you can't rent it out. And now, what is that going to cost you in terms of a reduction in your income on that property? Now, I mentioned timing risk. Timing risk is one that really depends on if you're trying to flip something, we'll say, or if you're thinking, I'm going to buy this place, I'm going to do it up really quickly, and I'm going to rent it out. And I'm going to rent it out so quickly that it covers the new rent that I'm getting in, will cover the cost of the refurbishment or whatever. And that's a great idea, but you can run into issues with timing risk. And if you get into the area of development, as opposed to just simply investing in a property, but if you buy raw land and you're going through the planning process and all that, then timing is a major risk, because you go and buy a property and go for planning, that could add 2 to 3 years to your timeline. And suddenly, in 2 to 3 years, who knows where the market is? Like if you go back now a couple of years, COVID, that had a dramatic impact on the market. But for a couple of months, there was a lot of people that were laid off and furloughed and stuff. And so you had no idea like where the income was going to come for those guys. Another risk to consider, and this is where you need to have your own self-awareness, is what I call execution risk. And that is where you point the finger at yourself. Do you have the skills that are required for this deal to go through smoothly? A lot of people will, lack confidence, but then there's also a few people out there who are overconfident. And if you walk into a deal bit overconfident and cocky, you can suddenly find, whoa, I had no idea that that was an issue. Next minute, you were the cause of the risk, not anything else. There's funding risk. When you go in and you're buying a property and you're thinking to yourself, what I'll do is I'll do it up and then I'll refinance it and I'll get my money back, which is the B or model. That's all fine if you're able to get it refinanced. But if you're not able to get it refinanced, then that's a funding risk, because you might go to a guy, a mortgage provider or whatever, you might say, hey, I've just spent all this money doing this property up. Can you help me get my money back? And they turn around and they say, well, sorry, but our valuer says it's worth this. And that may be just because the mortgage provider has a strict policy around a type of area or type of property use or whatever. Those of you getting into development again, construction risk. That's a very obvious one. You can hire a contractor to go and do a job and he'll give you a price, but a lot of the time there is unforced errors and things come along and suddenly you put a spade in the ground and you discover there's a big rock there that you didn't think was there, and now that has to be, you have to get special equipment to take that out and whatever it might be. Construction brings all sorts of risks with it, and it also brings potential delays with it, which goes back to the timing risk. You have to think about your unforeseen risks, and this is, to use one example of an unforeseen risk, events. Events are unforeseen risks, global events, things like Donald Trump invading Venezuela, Russia invading Ukraine, China now that everyone's talking about. Is it possible that China will use what America has done to go and invade Taiwan? They're talking about now the US looking at Greenland as a possible risk. Like, this is all political risk and events that take place, like, for example, the 9/11 attacks on New York City in 2001. Those were events, nobody saw it coming, and it had a very, very dramatic impact on the market. So there are unforeseen risks that you don't even know. So they're completely outside of your control. They're not even something that you know is likely to happen or not. But what you have to weigh up whenever you're doing a deal is this one deal that I'm doing, does it have the potential to sink me financially if something like an event goes wrong and the market was to change? And some people will, say to themselves, well, I have no idea, but it's, I'll be no worse off than I am today if this goes to shit. And so they might decide just to kind of go with that. But you just have to be aware when you are using leverage. And what I mean by that is, like, back some of the deals that I did when I made the most money that I made were highly, highly leveraged deals where I was only putting in maybe 50 or 100 grand and I was borrowing 2 million or something like that. And in those situations, like when you're borrowing 20 times the amount of money that you're putting in, you can have a 20x loss on all of the money that you put in. Like, you put in 100 grand, but you now owe 1.9 million to the bank. Those are the kind of risks that if there was an event, it could have a very dramatic impact on your life. You could be made bankrupt very quickly if an event was to take place just after you've signed a deal that was highly leveraged. And then those kind of things there, you have to feed that into your exit risk. There's always going to be a number of scenarios that you run. And those scenarios you have to think about. My preferred scenario is that I exit the deal at this price and I make a nice big profit and aren't I great? But then what if that falls by the wayside? Why might it fall by the wayside? Well, what if the person that you're selling to pulls out of the deal, or turns out they have some problem with some other property, and all of a sudden you're no longer, your option A that you were always going to go for disappears as an option. That's a risk. That's a scenario that you have to run through. And so you think about, okay, my preferred exit scenario is that I sell to this person. But what if that person goes bankrupt? What if that person pulls out of the deal? What if that person runs into difficulties themselves? What is my fallback position? If I was to put this on the market, are there other buyers? If that person who's pulled out of the deal has pulled out because of the market, would other buyers now pull out because of the market? If I was to lose that deal to that person, do I need to substantially drop my price? And you run through different scenarios and you can work out that worst case scenario, maybe I hold on to the property and I rent it and I'll cash flow it. And that might be a perfectly viable thing. But you might also find that, whoa, my borrowings are actually going to be greater than my income if I was to rent this. And therefore I'll actually won't be able to hold on to it for the long term. And these are the kind of risks that it's worth your while just being aware, so that if something goes wrong, you've actually considered it at the outset. Cost control risk is another. That is down to if you're refurbishing a property or if you're going into construction, can you control the costs? And then the final one, and this is one that I'll finish on because I read in the paper just the other day that North Dublin now has a problem with electricity production. And they're saying that at some point next year, it's possible that they won't be able to approve any more housing developments because they have an inability to actually bring power to them. So we would call this infrastructure risk. Now, it just beggars belief that we're in the middle of a housing crisis and that this is actually a potential issue, that we could run out of electricity. But these are the kind of issues that we're dealing with in this country, here in Ireland anyway. And you have to think about that when you're looking at buying a piece of land in, we'll say, an area, maybe it's the edge of a town, and you're thinking, you know what, this town is growing quickly. I bet you 5-10 years from now, this land that I'm buying will be rezoned. And that is a very good, very smart way to go after a deal. But the thing is will the roads be there? Will the electricity be there? Will the sewage system be there? And will the water be there? If you don't have access to those services, the infrastructure, then even if it got rezoned, it doesn't mean that you can start building on it straight away. And so infrastructure risk is another one. And so this is kind of stuff that I cover inside of the accelerator. We have a couple of workshops coming up in the near future. So you guys might be interested in joining one of those. They're going to be for free, and it means you can just kind of listen in while I go through some of this stuff. But if that is of interest, please get in contact, and I'll be sending out details on the date for the next webinar and workshop. Just to finish on this, we were talking about the Venezuela thing, and I said that, politically, what are we going to talk about? I mean, Donald Trump, just a few months ago, he was talking about, being made, getting given the Nobel Peace Prize for ending all these wars. And then a few months later, he's, invading a sovereign country and bringing a guy to, as he calls it, justice back in the US. But he went into the country illegally. Like, they didn't involve the UN. They just went and did this unilaterally. So how can you be bringing somebody to justice when nabbing them from their country in the first instance wasn't done in a way that was internationally legal? Huge amount of concern in the world around the actions of Donald Trump. Now, I know in the US, a lot of people will be supporting this and saying it's great because Maduro was kind of a dictator. And so certainly people in Venezuela will see this as a win because finally they get rid of the guy. But I think that this adds a huge amount of uncertainty to the world. And we were talking about political risks. This is definitely a political risk now for investors around the world, because you had the US, okay, obviously Donald Trump is a bit of a law unto himself, but you had the US giving out about, Russia invading Ukraine. And then here they go and they basically step in and they take somebody out of their country to bring them back to justice in their own country. And they do it unilaterally on their own. Now, all of a sudden, Russia can turn around and say, well, how does that compare with what you're doing, what we're doing in Ukraine? Or if China decides that they want to invade Taiwan now, the US can't sort of say, hey, you can't do this, when they've after gone and doing it themselves. So I think there's a certain amount of instability that this has introduced to the world at a time when we really don't need this kind of instability. Will it affect the property market? Probably not. But it is something that could be, a couple more events like this, and there could be some sort of an issue, international kind of, conflict or something like that could come about. Like if Taiwan was invaded by China, are we getting into a war between the US and China? That's going to be a fairly significant conflict if it does happen. And you can bet your top dollar that is going to have a major impact on the markets. And so that's one of the reasons why these unforeseen risks are so important. And so when you're looking at a deal, don't be thinking about a deal in isolation and thinking about, this market, it's only going one way, I'm going to go all in. If you're going to go all in, then make sure you've got protections in place. And by protections, I mean, make sure that, maybe you've got a limited company that owns the asset or something, rather than you owning it personally. If you own it personally and this thing tanks, you're going to end up owing the bank, and they can go after your other assets. And so sometimes it's important to put protections in place and have it ring fenced. And so anyway, guys, I hope you found this one useful, interesting, and we'll catch you in the next one. Thank you for tuning in to another episode of Behind the Facade. If you enjoyed the show or found it in any way useful, could I please ask you to take a moment to leave a review over on iTunes or Spotify. This really helps us get the podcast out in front of more people. If you have any questions or topics you would like me to cover in future episodes, please connect with me via my school community. You will find a link in the show notes. That's all for now. See you back here, same time next week.